Hey everyone, Don Yoakum here. Today, instead of previewing some of the data coming out next week, the big thing is the Fed FOMC meeting, right? Whether or not they're going to bother to raise rates. I doubt they'll cut them quite at this point. That would certainly be pretty reactionary, seen as pretty reactionary on their part. But there's definitely a pretty good chance, in my estimation, that they will not raise rates. I was inspired by an article that I saw. This is what you see on the slide right here. It's Simon White from Bloomberg Macro. I've got the link down below. You should be able to Google it and find it based on all this information. But what I wanted to do, I thought it was a great article. It had some interesting slides that describe what's going on pretty accurately in the banking sector right now and its effect on liquidity conditions. So what I wanted to do was walk through a couple of those slides and then add, what interest rates. So there's all kinds of market rates out there, all kinds of interest rates, and from them you can infer what the market is thinking, right? What the market is worried about. Bond markets are way smarter than stock markets in showing you where people think things are going, right? Or at least they provide a better window as to what people expect, what the markets expect, what investors expect going forward. So I just want to walk through those, give you a little bit of commentary around them, and let's take a look at what I see. Wanted to put these slides together so I could share them with you. Okay, let me get started here. So okay, here's one of the slides from the article. All right, so the problem that banks are facing right now. So you have this gold line here. This gold line here, that's the Fed funds rate. Okay, we all know that they were at zero, at post-COVID, and frankly, for most of the last decade, they started to creep up a little bit, and then COVID came. They had to go back down to zero, and now this is what the markets have been dealing with: is this nearly 500 basis point interest rate hike. And down here, this black line, the deposits, right? These are the rates that are paid on deposits. Banks did not increase how much they're paying depositors on their deposits. Now that created a problem, right? Because depositors have options. They don't have to put their money in banks and checking accounts and safety and savings accounts and that sort of thing. They can go to money market funds. Money market funds didn't offer anything extra than deposits for years. But now, and you can see down here, this is the blue line along with this Fed funds rate. Money market rates rates on money market funds have gone up with the Fed funds rate. Excuse me. So, this money market fund, it looks way more appealing than this deposit here. So deposits have naturally been leaving the banking system and going into money market funds. Now, the other side of this is the asset side of the balance sheet for banks, right? Banks take deposits and then they go buy treasuries and agency securities. They make loans with it, right? So basically they buy loans, is another way to think about it. All of those things they buy interest rate bearing securities. Those interest rates bearing securities pay more than what they pay on their deposits, and that's their profit. And that's their profit, right? And those profit margins have hung in there because deposit rates have not risen, but the yield on their portfolios has, right? Well, this gold line here is the deposits, and you can see that deposits started, going down in 2020, right? But banks were very over. I've covered this several times, but banks had a significant amount of excess reserves, right? They didn't put all that money that they got from QE and COVID stimulus. They didn't really put that money to work, not all of it anyway, right? And so what they could do is they could afford to let deposits go out without actually having to significantly reduce their treasury positions. They were over reserved, right? There are reserve requirements that banks must maintain, typically around 10%. They must have at least 10% cash relative to their assets. Okay, it's don't get too worried, don't get too caught up in it if you don't understand it. Other than the fact that at some point they have to start selling their treasuries. Well, you could see that they started reducing and this black line here is the treasury holdings. They started reducing that midway through last year, and now, but they still had plenty of cushion. Deposits were falling much more quickly, and now we've kind of reached, this a point where treasuries or their assets, they have to sell their bond portfolios, treasuries, agencies, whatever you want to call them. They have to sell them as deposits leave the door. And those treasuries now are underwater, right? They have losses on those portfolios. They bought them when yields were very low. Yields have gone up, you know this story, and that means that the bond prices have gone down as yields rise. And so now they're recognizing these losses, and you can see deposits now are going below this threshold, you know, are really starting to leave. Well, of course, you know, that's what's really triggered this crisis. That's what's made it acute. And this right here, you can see this diversion. And anyway, so there's a fair amount of treasuries that haven't been sold that will likely be sold. And, you know, now deposits, you know, not only are they going because money market rates are better, but depositors are starting to have real concerns about banks and looking at money market funds, right? All right. So, before I get into this, all right. So all of this is liquidity, right? The money is leaving the banking system, and therefore leverage is coming out of the banking system, and that starts to create liquidity constraints. That starts to create a cash when banks and financial institutions and money market funds and the entire ecosystem, a financial ecosystem, relies on very short-term funding, overnight funding rates, right? So when there are problems with liquidity, you start to see that in the overnight funding rates. And we're going to look at a couple of those. Here is, you know, think about it as banks and bond funds and money market funds. They're all counterparties, broker dealers, proprietary trading desk on brokerage desk at Wall Street, you know, hedge funds. They all play this. This is how leverage gets moved around the system. And they all leverage up their positions, their portfolios, that sort of thing. And the way that one way that you see this is what's called general collateral. Now, general collateral is, you know, a bank or a hedge fund or a bond fund. They say, hey, look, I need to borrow money overnight. And they roll these positions every night, right? It's not like, oh, just for one off. They're constantly, continuously rolling money overnight. Here you see the volume of the black line is the volume. It's relatively stable, right? This blue line is what's called the general collateral rate. So they can, hey, I'm gonna lend you my treasury bonds. I'm not going to tell you exactly which ones, but they're going to be short term. You know, we don't have to specifically identify them as general. And tomorrow I'll send you some treasuries and they meet your criteria, right? And there's a counterparty risk associated with that, right? Because who knows, you know, the bank might go belly up, the bond fund might suffer significant losses, and they may need more money to cover, right? So that's counterparty risk, a form of very short-term credit risk between these all of the financial institutions. And you can see that this was last Friday when SVB, this and then it started heading up, right? This is a signal that people are getting this rate rise. This shows you what that collateral rate, that blue line shows you that collateral rate rising. And that means, oh my gosh, money is getting tight. People are starting to get a little worried. It's not massive, right? But it is a pretty significant move on a relative basis. Here's another way of looking at the exact same thing. It's the forward rate overnight interest swap spread. Okay, so it is again just a signal of how it's a price at which financial institutions lend money overnight. And it's good. This one goes all the way back to 2009, right? So you can see what happened. It really blew up during the great financial crisis, and then we moderated, and then we've had, you know, as the Fed started to raise rates back in 2016, it started to create tightness, liquidity problems, and then they solved it. You know, all of these spikes, and ultimately they gave up on it. But now we're having another spike. Now, is it significantly higher than what we've got over the last when it's peaked up in the past? No, not yet. No, it's certainly not up at these levels. And I apologize, this slide doesn't show the numbers here. But at least it shows you magnitude, right? We're probably at around what this is 20 base. This is probably 20 basis points. We're up to 40 basis points, I bet, is where we are right now. But in any case, you can see it jumped up very quickly. as a result of SVB collapse and the overall fear in the banking system. This is something to keep an eye on. If it starts creeping up here, this is probably 60 basis points up here. Then we're really starting to have problems. This type of overnight funding rate is financial institutions are very sensitive to these rates. Their profitability is, and that sort of thing. Okay. And that's the overnight markets for short-term money and liquidity signals, right? So, there's a real fear out there. Now, what this means is the Fed can't keep raising rates because that only worsens the liquidity problem. It worsens the disparity that banks have to pay on their interest rates. Ooh, let me go back. I'm sorry. I'm going to go back and cover something that I didn't specifically state here. Back on these deposit rates. So here's the choice that banks have. They will continue to lose deposits and be forced to sell treasuries unless they significantly raise deposit rates. Net result, either they recognize losses on those treasuries that they have to sell to meet the deposit outflows, or they crush their profitability by trying to maintain those deposits and paying higher rates, right? And that's significant because banks and the entire world has not had to deal with banks not having money basically handed to them because of the Fed's actions over the last 15 years. So, that's back to this. Anyway, so there's liquidity crisis. The banks are challenged. The Fed's hands are tied. We're going to see what that means. I'll talk about what that means a little bit in terms of inflation and growth in here in a second, but let's see what the market is telling us. The other sign of stress is credit spreads. Okay, so this is high yield bonds. So this is the spreads that high yield bonds basically earn over 10-year treasuries or 5-year treasuries. Doesn't really matter. Here again, you can see what it was. Oh, this was 2020, right? So COVID, massive spike, right? And then it moderated. And this is roughly the type of spread that you've seen probably over the last 10 years, 15 years. But now it's starting to creep up again. They're not at flat out panic levels yet, but they're getting close, right? And this is a new phenomenon. Credit spreads have been coming down generally over the last year while the Fed's been hiking rates, and now that's turned. Okay, so if banks can't lend because their balance sheets are shrinking, it's hard. It is, and if leverage is coming out of the system, it's hard for high yield bonds to borrow money, to maintain their operations and that sort of thing. And nobody really wants to give them capital. Same thing on this is the BBB index. So right, this is the lowest of investment grade, and you're seeing the exact same thing pop. Now, here's the recession signal. We've gone over this time and time again. This is the difference between the 10-year and the 2-year treasury. If it's above this line, which is 0, so all of this area up here, this is a positive spread, and that the 10-year longer-term bonds are earning more than shorter-term bonds. That's the way it should be. When recessions start to become a fear, right, it drops below 0. Right. And you could see this trend, these fears started creeping in the market way back in 2021. And then through last year, they became steeply negative, right? We're down to below 100 basis points. We got down to below 100 basis points right here. And that's where it bottomed. That's the lowest level. That's the steepest inversion of the yield curve since early 80s. In that recession when Volcker was hiking rates aggressively. But now that the banks have starting to show weakness and the SVB collapsed and all those kind of fears, the Fed rate, the markets are now, boom, you can see this popped right back up to around less than 50 basis points. So that steepness reduced itself by more than half. And okay, so that means, all right, maybe we don't expect the recession there's an end in sight. The end of the recession is getting closer in sight, right? But it doesn't mean that we're not going to have a recession right now. It just means that at some point, the recession will end. That's really all that's saying. But at least they're now starting to discount an end to the recession because the Fed is probably going to start lowering rates. They will pivot. And then bond markets also tell us what they are thinking about in terms of inflation expectations and real yields, and whether or not those real yields are, and then, well, you kind of have to infer whether the real yields are pro-growth or not. But here's the 10-year inflation expectations. They're moderate. They got up to around 3%, which is definitely high historically speaking over the last 20, 30 years since we've had this great moderation in inflation rates. I'd say over the last 20 years. But now, they're down a little over 2. So this is not extreme inflation expectations by any stretch. Now, I'm not saying that inflation won't go on a tear once the Fed is done cutting rates and re-stimulating the economy and stops taking money out of the system and leverage comes back into the system. But right now, the bond markets aren't too worried about that, right? There's growth is what's most immediately on their mind. 5 years kind of is telling us the same thing. If I look at real yields, 10-year real yields, so real yields tell you two things, right? They either they raise, they go up usually because the Fed, liquidity is making the cost of money very tight, or the growth in the economy is very strong, and so money becomes tight as people demand more money to take care to take advantage of growth, or it starts to become a real inhibitor to growth when the Fed hikes rates. Right? That's what they were negative. Real yields were negative. They were telling us a recession was coming. Now the Fed hiked rates, and so real yields rose. That kind of guaranteed a recession. And now they're starting to creep down a little bit. I'd say the real yields have peaked because the Fed's tightening cycle is going to peak, and it'll be interesting to see where these head back down. I wouldn't be surprised if they end up being negative by the time the Fed is cutting, and they will probably end up having to cut close to zero. 5-year inflation. What is that? I didn't change the. Okay, so this is real yield. Sorry about this label. 5-year inflation expectations monitoring, but this is the 5-year real yields, and that's kind of telling that they peaked, and then they're coming back in. So, it's not a matter of real yields are not predicting growth, right? They're just predicting a less aggressive Fed and probably back to negative real yield territory. Anyway, that's what the market's telling us right now, guys. I appreciate you taking the time. I think the real crux of the situation here, what I expect is that the Fed, when it starts cutting, and it's going to be forced to cut, and the recession will be very deep, but inflation may not peak start creeping back into the system immediately. It may have indeed moderated for a while, but at some point, as the Fed tries to reinflate the economy, that's going to be a real problem. And real assets like gold and real estate and those sorts of things are going to be very valuable over the time. So anyway, that's what I got, guys. Really appreciate your time, and we'll talk to you later. Thanks.